Good morning, Uzo. Good morning, Pav.
Hi, good morning.
Morning, James. Thanks for having us.
Well, thanks very much for doing this. We've had Schroders British Opportunities on before, but with the other managers. So keen to hear from you. We've got quite a lot of slides. I think, as per usual, although we've talked to you before, let's sort of run through the case for the fund first, if you don't mind, and then we can bring us some questions from the audience.
Yep. Okay, that's fine. So I'm happy to start with that on slide 3, if we move towards there. So if we just think about what does this trust do? So for those that are hearing about us for the first time, we invest in both public and private equities within the UK, and our focus is small and mid-cap equities, so with market capitalizations of between £50 million and £2 billion. Our focus is on growth equity. So we want to find businesses that can compound their earnings over time and create value for our shareholders. And as you saw just the slide before, that we do have a strong team of individuals. So there's myself on the public equity side, Pav on the private equity side, and we are backed by a greater number of people in both respective teams, and then our other co-portfolio managers who unfortunately are not here today, Rory Bateman and Tim Creed. So if I move to slide 4. Thank you. So why public-private? So look, the first thing is that we think that what sets this strategy apart from other funds is that we have really an expansive universe that is not just focused on only investing in public companies or only investing in private companies. And because that universe is enhanced, it means that we have the visibility as to what the overall competitive landscape looks like for the companies that we invest in. So if you think about companies that list on the stock markets, they have their information freely available to everybody. So historically, there's always been greater insights that private equity investors can gain when making their investment decisions in terms of, how similar peers are faring. But the same hasn't always been true for public market equity investors. So in this way, through our strategy, we have the opportunity to invest in the best companies within a given industry, regardless of whether that company is public or private. And we think that in doing so, that we can deliver the best financial outcomes for our clients. I think that the second point here is also quite important, is that in creating a product that has private equity within it, we are providing democratized access to exciting companies that historically retail investors have not been able to access. And I'm sure we'll come on to that later on this morning. And then finally, in relation to the opportunity within this vehicle, we think that our assets on both the public and the private equity side are priced at a substantial discount to fair value, which we will explain shortly. So if we just move on to if we move on to slide 6, actually. Thank you. Yeah. Okay, so this chart shows the performance of our NAV, that's the green line, mapped against the performance of our share price, so that's the blue line, since the trust's inception. So we launched this trust at the beginning of December 2020. So in early 2022, we were trading at a very small premium to our net asset value. And then, as we all recall, the Russia-Ukraine crisis really began soon thereafter. Inflation continued to rise globally thereafter, as well as here in the UK. And then you saw central banks begin to increase their interest rates. And as a result, there was a market shift away from growth working as a style and towards value investing. So the combination of all of this, so basically I'm talking about weaker macroeconomic sentiment, that's really led to that decoupling that you see between both lines, and we're currently sitting on around a 33% discount to NAV. So perhaps I'll hand over to Pav to explain a little bit further.
Super. James, if you could just go to slide 10 at this point, we just talk about where we sit today. So how do we fare and where do we sit today in terms of the portfolio positioning and the industry composition? We're 65% invested in private, 35 public. We actually removed a limitation that we had at the outset, which had a 50-50 split guidance in the fall of last year, and that was largely for two reasons. A, the performance in the NAV growth in the private was sort of pushing that limit, and also we wanted to have more autonomy in where we find the best opportunities, to Uzo's point earlier. And then if we look at it from a sector split, we're very diversified. We're a very diversified portfolio with a slight tilt towards technology, which we're comfortable about having. And just to give you some sort of data points as to where we are in terms of size, start of this week, we were about 78 million NAV, a market cap of around 51 million, and just shy of 8 million in cash as at 31 March, which has broadly been the case. If we move on to the next slide, James, you'll see here our top 10 holdings. And I think the key point to take here is we've got 8 out of 10 of the assets from the private side, and you'll see 2 public there. And the principal point here is the top 10 investments constitute broadly 67% of your total investments. And really what we have here is a very highly diversified collection of assets and exposure. So software, payments, healthcare, business services, and digital parking is some of the sectors that or themes rather that we play in the fund. Perhaps with that, I will take you to slide 13, and I'll just touch a bit on the private equity strategy and how we look like in terms of the PE sleeve. So what we've tried to do here is really kind of illustrate and contextualize the private equity landscape by company lifecycle. And the areas in the dark blue are the focus areas for this fund from a private equity perspective. So we invest in growth capital, and we also invest in buyout. And where we invest in buyout, we focus on the small and mid market, and that's typically enterprise values of 50 to 2 billion, as Uzo said earlier. And that's something that we invest in within this fund, but also as a private equity practice as a whole. And I'm sure the audience are aware, but when we say growth capital, we're talking about investing in companies that are in that growth phase and are requiring capital to fund further expansion. And where we talk about buyout, this is acquiring established and profitable companies and really drive strategic and operational improvements with the ultimate aim of achieving an attractive exit point. The other 2 things I just want to quickly draw out here are the 2 purple boxes on either side of the blue with the arrows pointed down. And really the point we want to make here is what we've been doing as a practice for some time alongside our data science team is really tracking how fundraising has been evolving in the private equity and venture landscape. And what we noticed is that in the late stage venture and pre-IPO market, as well as the mega buyout market, we've seen that the fundraising over the last decade has significantly exceeded the trend, our forecasts of fundraising when you look back at history. And what that had meant is that the growth in capital raised in these markets versus measured against the number of assets to deploy into was disproportionately large. So this is a part of a market that we intentionally have stayed away from. And ultimately, we felt that would lead to pricing risk. And, lo and behold, it has. And these are the parts of the market that we would, where we have seen as a private equity practice the most substantiated retrenchment in valuations, late stage and late stage VC and mega cap buyout. The top and tail boxes, venture, seed, and turnaround, we invest in as a practice, but we don't invest in within this strategy. And then moving on to slide 14, what does our strategy look like on the private equity side? I think the key point to bring out on this slide is that we have built a private equity portfolio that is biased towards buyout companies, which in the main are profitable companies that exhibit high EBITDA margins and very high cash flow conversion rates. But the portfolio was intentionally constructed to have exposure to some exciting growth assets. And that's really, that gives us the ability to deliver the outsized returns and really augment our portfolio construction. In terms of the portfolio as a whole, I'd say 8 out of 9 companies are meeting or significantly exceeding our base case underwriting at the time of investment. And just talking to those in terms of the aggregated portfolio metrics, we've seen, on average 40% sales growth over the last 12 months and 45% EBITDA margins in the profitable names. And that's, that kind of talks to the strength and resilience of the book that we've built. Uzo, perhaps I'll pass back to you to just touch on the public equity strategy.
Yeah, thank you, Pav. So James, if we could move to slide 18, if that's all right. Yeah, perfect, thank you. So as we mentioned earlier, that we look at companies on both the public and the private side with a £50 million to £2 billion market cap. And within the public equity sleeve, we think about our opportunities in two broad buckets. So the first is what we call mispriced growth. And these are companies that may have had a little bit of a wobble in terms of their share price, but we think that the market is materially undervaluing the long-term opportunity, possibly because they need an fresh equity capital raise is required in order to restore their balance sheets. There was more of an opportunity to invest in some of these businesses during the pandemic, as balance sheets had become a little bit over-levered with companies that still had really strong global franchises. For example, a company called SSP, whose rights issue that we participated in 2021. Then we have another bucket in which we call high growth, and this really is our bread and butter. So it's important to stress that we don't really do that much mispriced growth, that the high growth opportunity is where we see most of our investments being. So we look for businesses that are compounding their revenues and earnings really, really strongly. So these companies have really strong balance sheets, but perhaps maybe they may need to come to the market to raise equity from their shareholders in order to fund, for instance, a transformational M&A deal. So whilst we don't just invest in opportunities that require equity funding, we do support we do think it's important to support our investee companies for transactions that we think would be earnings accretive. And in total, just for context, we've participated in around 13 primary or secondary equity raises and about 4 IPOs since the launch of the fund. So I'll just hand over to Pav.
If you could go to slide 22, please, James. This is for us, a key slide and a key message that we want to leave with our audience. This is our views on the mispricing and the discount that we're currently trading at. Internally, we call this the math slide. And just to take you through, what we have on the left-hand side is the NAV per share bucketed into the different components. So, broadly 33% of NAV in public, 7.9 in cash, and 61p worth of value from the private equity investments. And how does that marry up to the share price? Well, if we make the assumption that the equity markets are prudent are pricing in prudence on the UK side in terms of UK sentiment and also growth assets, and that is so your value is fully reflected there. You've basically got your 33 pence. Cash is cash, which is a 7.9. The plug figure becomes 27.5 pence. So that implicitly implies a 55% discount on that the market is pricing into the private equity investments, which we think is a huge injustice. On the basis of the powerful growth that we've had in the companies in terms of the underlying earnings. And by the way, most of that is driven by the fact that we have a lot of market leaders in their respective niches and have been able to grow in what are very tricky economic conditions. And B, we've priced in a significant multiple contraction into the valuation of our assets. And, as a practice, we are we always take a very prudent approach. And so, in spite of that, we are still being kind of tarnished with this significant discount. So, the point here, to make here is, I think, we believe this is a very attractive entry point for investors. Uzo, do you want to just wrap up on the outlook?
Yeah, sure. So next slide, please. So just to wrap up our presentation, so our private equity allocation has performed very, very well, and we are really excited about the progress there. And the public equity side of the portfolio, even though it has been held back by negative market sentiment within the small and mid-cap space, we do see significant discounts in several of our stocks. And it's worth pointing out that 3 of our companies on the public side were actually taken out, or rather they received bids last year, and 2 of the 3 were successfully taken out, either by corporates or private equity. And just from the opportunities that we see in the public sleeve, we do think that there's potential for more to come. And then finally, our enhanced universe, which I mentioned at the start, really means that there is no shortage of investment opportunities from our perspective. So yeah, thanks a lot, and I'm happy to answer questions.
That's great. Thank you both. Where should we start? Let's start with cash first, actually. So why do you hold 8 million in cash in the fund of this size?
Yeah, it's a really good question. I think we're just being very, very conservative at the moment, just because markets have been incredibly choppy. So we are keeping our powder dry. The other reason is because there are some capital calls, or rather capital commitments, that we've made on the private equity side, which could come at any particular time. So it's important just to have some powder dry there.
Okay, that makes sense. Now, I don't think this is right. The question here is saying that 37% of the fund is invested in Oxford Nanopore. I think the last fact sheet I saw is more like sort of 20-something. But nevertheless, there's quite a concentration there. Is that just come from the relative valuation movements? How do you actually manage the size of positions within the fund?
So maybe I'll pick this one up. So Oxford Nanopore is not in this trust. That is in another investment trust, the Innov vehicle that's run by Schroders. So that's that's an easy one. But I mean, in terms of portfolio construction, look, we go into these positions knowing, or rather, when we're building the portfolio, we know that certainly on the private side, we underwrite typically to on the buyout side, sort of a 3 to 5 year hold, and on the growth side, more like a sort of 5 to 7 year hold. So, we're going into these positions knowing that this is patient capital, and we work with the companies to grow the businesses both organically and inorganically, and the liquidity management is really done by having a prudent approach to holding cash, but also having liquidity in the public names should we need it. But this is more a trust where investors would need to be patient in terms of seeing sort of the alpha come through.
Yeah, and there's the top 10 holdings, which makes more sense. And actually, I've spotted what the problem is from our point of view, is that the link on our website sends the wrong fund. There we go. Apologies for that.
Yeah.
Cool. Actually, this is funny question at the beginning here. So can you sort of tell us a bit more about some of these companies in the private portfolio, just because the people, I suppose, are probably less familiar with them than some of the listed ones, please?
Absolutely. No, delighted to. I think I mean, there's quite a few names here that we're excited about and are market leaders in their respective subsegments. But maybe I'll talk about Mintech, which is a company that's performing or exceeding its base case expectations. And really, so what we liked about Mintech at the outset is it's serving an industry that's historically suffered from price transparency issues, and for large corporates, this has led to inefficiencies in negotiating and budgeting. And so what they offer is a mission critical product to the largest industrial sector globally, which is the food sector, which is roughly around $10 trillion in value and about 10% of GDP, and they're serving blue chip names that we're all familiar with: Unilever, Tesco, Mars, etc. So, this was an asset that it was an opportunity to back a market leader who had very strong growth opportunities in what we felt is a greenfield market. On the basis of the leading position that they've built in their data collection and their data sources, and also the data analysis, which is the price forecasting, which is ultimately what they do. Mintech being a price reporting agency providing price transparency for food, and really this is a great example of British innovation. It's a company that's founded in the leafy Bourne End area of Buckinghamshire, and what they've built is a market leading position. So it's a great sort of British asset. And how's the company done since investment? It's as I say, it's performing exceptionally well, both organically, but recently, so in Q1, they closed a very large transformational add-on in a company called AgroBriefing, who are also a leading price reporting agency in North America, but focused on the agri-food industry, and sort of protein and various other things. So it makes the platform much more holistic in their offering, and significantly has changed the size and shape of business that we entered. So we're now much more excited in terms of their offering, but also the strategic interest in this asset. Maybe just to give you one more name, which would resonate, I know, with a lot of our audience, and we get a lot of questions about Easy Park. I know if you're much like me, you would have don't carry coins and notes anymore. So and I've noticed that when you're paying for parking, if you're using apps like Park Now or Ringo, they are brands and that are owned by Easy Park. And what we have in Easy Park is now the leading global digital parking payment company. So for us, this was an exciting story. It's a company that was founded in 1998 and really started in a local Scandinavian region, became a market leader in Europe, and we invested in them as a practice in 2018. And there was an opportunity to reinvest in the British Opportunities Trust when there was at the time the acquisition of Park Now, which really brought the US, UK, and Benelux, which are regions that they didn't have any exposure in, and we reinvested in 2021. So I had to delighted to have the opportunity there. But really here we were playing the shift in the adoption of smartphones and the shift towards digital payments in parking. And we really liked that it also brought with it a very strong value proposition to motorists, providing that convenience, time saving, and cost savings. And also there's an ESG angle there in that the apps do find you the closest place to park, and so you're not spending endless hours driving in circles looking for places to park. So again, we have quite a few of these in some of the other names, but this they are a market leader in their niche, and clearly being a market leader in tricky economic times such as we're in now means that you're able to take out competition at lower prices, but also importantly have the ability to pass on pricing if you're really entrenched in your customers' lives.
Yeah, exactly. Good, thank you. Can you actually talk to valuation a bit, please? Because I know some investors have got a perception that the private stuff isn't actually hasn't actually been sort of repriced to reflect what's going on in the public market.
No, absolutely. I mean, it's a great question. It's a question that we get a lot. So I mean, maybe I'll point you to slide 15 here. I think I would start by saying, when I talked about the private equity landscape, there are parts of the market that we felt had that were going to exhibit valuation risk, and they've seen the most retrenchment. So, we've stayed away from that part of the market. That's kind of number one. But if I talk to our own portfolio, this is our value creation bridge on the private equity side. So broadly speaking, we've invested 33 million. The fair market value of the assets is 48 million, but we've also had a distribution following the acquisition of WaterLogic by Culligan, which gave us back 2.4 million in cash. But the key things to draw out here are the two boxes in the middle. So the 14.5 green box and the -6.8, and I'll explain what they are. So the 14.5 is, that shows that the lion's share of the increase in fair market value in our assets has come from the underlying earnings performance and trading performance of the businesses. So this is real EBITDA growth. So if you take out the EBITDA growth or revenue growth, if where it's non-profitable and you're using revenue to value the asset. And so we've had this increase in valuation in spite of the red box, which is the -6.8. So that is where we're using listed comps to value our assets, which is the case in point in most of our assets. Where market multiples have come down, we've priced in that contraction, and this is something that we do both within this trust, but we do as a practice, and feel we're quite prudent in doing that in terms of the multiple. So in spite of that, we've still had this strong growth. So that's I think the point and the answer with respect to this fund. The other point maybe I'll just quickly touch on is this is market multiples. And clearly market multiples have come off, and as I say, we have taken that down. But as a practice, we invest in the small and mid part of the market. And what we've seen over the last 20 years where we've been investing is we're buying slightly more mismanaged businesses, sort of unprofessional businesses, founder-owned businesses. And with that, there is a secular uplift in the valuation you get at exit just by professionalizing these companies and selling them upstream to private equity that sits at the layer above, where there's a significant amount of capital and assets are still being bought. So yes, market multiples have come down, but historically, irrespective of cycle, we do normally get that uplift, but we're not capturing that here. So I think overall, I would say that I think our assets are valued very fairly, if not prudently, and the increase in the value hasn't been just us keeping the multiple flat, irrespective of markets coming down. It is the growth in the businesses, and the reason these businesses have been growing, as I touched on earlier, is really the market leading positions that they have, and so they are able to pass on pricing where there's inflation, and they're able to take out competition. So a lot of our businesses have buy and build as part of their strategy. And so where they have capital, they are taking out competition that's struggling at lower multiples, and you immediately get that sort of accretion when you come up to the platform. So hopefully that explains and alleviates some of the concerns around valuation with regards to SBO. Thank you.
Uzo, maybe. Where do you sort of sit on the hard landing versus soft landing thing for the UK economy? And what do you think the catalyst might be for a re-rating of the UK small cap market?
Yeah, so I think the first thing is perhaps maybe if I move you to slide 28, please. I can, yeah.
Yep.
Okay, so perhaps if I maybe talk about UK small and mid caps first, and why we think this is a really interesting opportunity. So this chart reflects the work that some of my colleagues have been doing on the UK equity desk at Schroders, and over the last 30 years or so, you can basically see when small and mid caps have underperformed the FTSE 100, so that's in red. It has usually been followed by periods of outperformance versus the FTSE 100 over the next 3 to 5 years. So you can see that in the blue bar and the green bars. So given the where we are at the moment in the current cycle, we do think that small and mid caps are well poised. But for us to get there, we think that we need a sustained slowing down of inflation, particularly the core inflation bit, because this will then obviously dictates the direction of central bank policy and when they can then start to really cut interest rates, which will then obviously have an impact on the discount rate for equities. So, you know, the last inflation print for the UK for June, which was just released a few days ago, was much better than expected, particularly on the core inflation piece. So in the short term, we do think that the July inflation numbers should be a lot better than the June numbers, because you have a few factors at play. You've got your comps getting a lot easier year on year. PPI is usually a leading indicator, and that continues to suggest an easing of underlying inflationary pressures. And then obviously you then also have the removal of the energy price cap. So there are quite a lot of reasons for us to be optimistic in the short term, but perhaps maybe just anchoring our view on the longer term opportunity. If you move to, I think it's slide, might be slide 19. Yeah.
In there.
Sorry. Lots of slides. Yep. So this is the opportunity that we see in the overall UK market. I'm sure your listeners would be very familiar about the fact that, you know, the UK market continues to trade at a significant discount to itself, but then also a significant discount to global equities. And that's been driven primarily since the Brexit vote at the end of 2016, or rather during 2016. And so whilst the UK market is cheap at a headline basis, we also see it being cheap across lots of different sectors. And so this sort of the cheap valuation is despite the fact that UK companies have some of the strongest balance sheets of their developed market peers. Cash to total assets continues to be really, really high. So overall, we don't like to kind of play into the short-term sentiment of is there going to be a hard landing or a soft landing. We really are long-term investors, and just primarily because of this chart, we think that the UK equities are significantly attractive at the moment.
Good. Fingers crossed. And in terms of the split of the portfolio between public and private, is there an intention to kind of rebalance it?
That's a good question. Maybe I'll pick this one up. I think, I mean, the term that we use as an investment team on this trust is a competition for capital. So I think you know, we're 65 private now. Will we go further? I think we are seeing a lot of opportunities on the private side, but I think the word for us is or the words rather, are high selectivity. So where we've vetted a number of deals on the private side, and we have conversations with Uzo and the public team, and really underwrite to say, look, what are you seeing on your side? I think this is one of the merits of having a public-private investment team on the trust. So it's hard to know in percentage terms where we might get to, but I think it's fair to say we are seeing some attractive opportunities on both sides. But I would say it's split that's not significantly dissimilar to where we are today, but have some exciting pipeline positions on both sides.
One of the things that other funds in your sector have been focusing on is trying to shift as many companies as possible into being a sort of state of being self-funding. Have you got any funding concerns around any of your companies?
No, it's a good question. I mean, as I said earlier, we are focused principally on buyout. So if we take them aside, you know, the profitable ones, fine. I think in terms of the growth companies, they are well funded to profitability in the main. I think the only company that's has some more sort of idiosyncratic challenges is Graphcore, but I think that is within a sector that we are you know, still very excited about. You know, the compute layer for artificial intelligence, which is an area that's you know, as you will have known, you know, blown up over the last 6 to 9 months since the launch of ChatGPT, and the compute layer is integral to that, and it's a very large market. I think the company is doing the right things strategically, and we're working with it, and we also have a very strong syndicate around the table, which is important in difficult times. So we think the company's making the right strides there, but again, we don't have any short-term concerns in terms of funding and cash runways for our assets. Is I think the
fair enough
answer there.
I mean, I'm intrigued by GraphCore. I just don't know why somebody isn't come along and buy it, given the technology seems to work.
Yeah, I mean, it's one, when the investment thesis for us hasn't changed here. I mean, there's been multiple studies which shows that they have superior technology versus some of their competitors, but one of their main competitors is very active, and there's a lot of fierce competition, shall we say. And I think there's also the political angle here, in that the US DOC has made it difficult to trade into China, for US and UK, and that's having an impact. So yeah, absolutely. I think, in terms of the IP that they've built and the team that they have, with Nigel and co, it's a very strong roster. So, I'm still, optimistic, but to be transparent, that it is a challenging market, that the hardware space, just given the long sales cycles for the clients that they're talking to.
Just on a process basis, just jumping back slightly. So, Uzo, what triggers sales of things that you hold in the public portfolio?
Yeah, it's a good question. So we are very valuation sensitive. So I would say that, if we felt that a company's valuation had run its course, then we would think about selling it. But I think it's important just to note that the public equity side of the portfolio has very low turnover, much lower than I think that you'd probably have for similar funds. So our turnover last year, I think, was about 10%. The year before, it was around 5%. So we don't expect to have a very high turnover, and it's a function of just the way in which Rory and I try to be long-term patient investors, but then also to try to mirror the strategy on the private equity side, which is obviously long-term patient capital. And this slide that I see that you've pointed to, it's probably maybe just worth talking about that as I mentioned earlier, that we have had a number of exits in our in the public equity side of the portfolio that have not been because of valuation reasons or other reasons. It's because these companies have been bid for. So we have had 5 since inception. So the first 2 were Callison and Blue Prism. So Callison happened just after the fund launched. Blue Prism happened in 2021, and then last year, quite a lot of the activity was EMIS, Euromoney, and Ideagen. So if you think about all of these 3 companies, EMIS, Euromoney, and Ideagen, they were very, very similar characteristics. So high cash conversion, high recurring revenues, really sort of tech-enabled businesses. And so as a result of the loss that we had in terms of quality from the portfolio last year, we have done a little bit more trading this year to increase the quality of the portfolio. So for instance, we added a new company called Bytes Technology.
Okay, thank you.
Yeah.
That probably answers the question here, was like, what companies are you most excited about on the public equity side of the portfolio? Yes,
I would say Bytes is one. As I said, it's high quality. For those that are aware of it, it basically it's a value-added reseller, and it primarily resells software products from Microsoft, and then other cybersecurity companies and other vendors like a Darktrace. And then the other one that I think is, so I should say that Bytes has done quite well for us since we included it earlier on this year. And then the other one that perhaps maybe has come off a little bit in the last 18 months or so is Watches of Switzerland. You would have seen that in our top 10, but we still really like it. I mean, at the moment it is lacking a little bit of earnings momentum, but we do think that over the long term it is a really strong earnings compounder, and there's just a really significant opportunity for it to gain scale in the US and in Europe.
Great, thank you. I'm afraid we've run out of time, I think, so we might have to leave it there. But thanks. I think we've covered an awful lot of ground this morning. So thank you both. Is there anything else you'd like to add before we close things down?
Perhaps maybe, would it be all right if we just talked about slide 9 just for a second, maybe just the last 1 minute, which sort of points to the fixed life nature of the fund. So for those that have perhaps read our perspectives, that there is a fixed life on the trust, and that continuation vote is on the 31st of May 2028. Now, just to be clear, we do want to run this trust beyond it. We think that the opportunity is incredibly exciting, but in terms of the 33% discount on the NAV currently at the moment, that does imply around an 8.5% implied annualized annual return between now and the continuation vote. So we think that that's a really interesting and attractive annual return that shareholders are getting.
Good. Yeah, actually, that's a valid point. Very valid point. Good. Well, thank you both very much for this. So it's interesting. We'll get you back on again in a year or so and see how things are going. But good luck with it all in the meantime.
Great.
Thank you, James. Thanks for having us.
Thank you for having us.
Thank you both. Good. Right now, take me a little while to get to the end, I think. So I'm not going to be able to dwell on the risk slides. So there they are. By all means, when you come and view it back again, pause on them and have a good read. They are important. There we go. Fortunately, we are running out of time. So we are back next week talking to impacts environmental markets. And we've got a sort of full roster for you. And as I said, the 25th of August, we're going to talk to Ian Pyle. So I think that's going to be interesting to find out and the rationale for that merger. And I'd like to see that fund get bigger again, to be honest, but we'll have to wait and see how that's going to happen. And then we've got a gap at the moment on 1st September. We do have Andrew Mahati, who'll also be on next week. And we'll get that slot filled up quite soon. So have a good week, one and all. And I will see you next Friday. Thanks, bye-bye.